Hi there, this is Tom Lee. I'm the Chief Investment Officer of Fundstrat Capital and the Portfolio Manager for Fundstrat's U.S. Large Cap Granny-Shots ETF. We know markets have had a fierce correction. The S&P 500 fell 10% over 20 trading days, and basically from mid-February. That is what I would call a waterfall decline. In fact, it's the fifth fastest decline for the S&P since 1950. In other words, in the last 75 years, there are only a handful of instances where markets have fallen this quickly. And I just want to show you what happened to markets in those previous instances. The fastest ever decline for 10% was during COVID. Those were these initial days. The second fastest was Trump's first term when the trade war broke out. The third was in 1955 when Eisenhower had a heart attack. The fourth was 1950 with the Korean War. The fifth was the Volcker shock, which was during the inflation crisis. And the sixth was the Asian financial crisis of 1997. So this is a similar shock. In each of those cases, markets ended up doing something what I call rage selling, which is a panic sale. But look at what markets did in the subsequent month, in the following month. Of those instances, only COVID saw further selling in markets. And the median return was 6% gain. 3 months later, 6 of 6 times the market was higher with a median gain of 9%. Over the next 6 months, the median gain was 15% and 6 of 6 saw higher gains. And then look at 12 months later, 6 of 6 were higher 12 months later with a median gain of 21%. So as much as you may think you don't want to own stocks until April 2nd, which is when the tariff deadline was set by the president, okay, I think there's a lot of reasons why we could be turning sooner. For instance, there was a tweet this morning, March 19th, where White House Economic Advisor Kevin Hassett said he spent the entire night with Commerce Secretary Lutnick and Treasury Secretary Bessent negotiating with other countries about mutually lowering tariffs ahead of the April 2nd deadline. Now, this got very little attention. For instance, there were no comments on this on Twitter, and you may even wonder, is this person even real? Yes, he is. He's actually a Fox Business correspondent, Edward Lawrence. And it corroborates a statement made by Treasury Secretary Bessent earlier in the week, where he was optimistic that reciprocal tariffs won't go into effect on April 2, or some of them won't, because some of these countries would have pre-negotiated a deal. That's just a reminder that President Trump is trying to make a deal, we believe, for tariffs rather than go and engage in a full-on tariff war. In fact, the best evidence for this is the relative performance of the 4 regions that are at the center of these tariff spats: China, Europe, Mexico, and Canada. Each of those countries has outperformed the US since February 18th. Another reason to not throw in the towel completely is the Fed is dovish, and we got a reminder of that with the March FOMC rate decision, which came at 2 o'clock on Wednesday. Markets actually immediately rallied, and it's a reminder the Fed was dovish. A couple of highlights I'd point out. First, Fed Chair Powell spoke about how the tariffs could create some inflation, but he viewed them largely as transitory. That's a good view. That's a good word, because that means the Fed won't necessarily take action to try to slow those inflation effects. And second, there was a question about stock markets and declines and whether that would catch the Fed's attention. And the Fed Chair Powell reiterated the financial conditions are the main channel to the real economy, so they are paying attention. And if the soft data, which is both surveys and I would say by implication the stock market, are weak, they don't want to dismiss it, so they'll watch it carefully. That's just a reminder the Fed put is alive and well. And also a reminder, maybe more broadly, to not time the market. And if you're thinking of throwing in the towel, one last thing I just want to highlight for you is that the Cuban Missile Crisis of 1962 might be a good template for how markets could react to the tariff wars. The crisis lasted 12 days, from October 16th to October 28th in 1962. And initially, the market fell 5% over 7 trading days. But notice it bottomed on October 23rd And it actually rose in the 5 days before the Cuban Missile Crisis was resolved. Think about that for a moment. The market was facing global nuclear annihilation, and the market bottomed 7 days into the crisis. And in fact, by the time the crisis was resolved on October 28th, 2/3 of the losses were recovered. So if that happened in 1962, I think the 2025 tariff crisis is going to play out similarly. Now let's turn our attention back to the ETF. And since the market highs, the stock that has fallen the most in our granny-shots portfolio is Tesla. It's down 31% in just 1 month. Now, there's many reasons people are going to speculate why Tesla's falling. You know, the stock's plummeted, but we think it's mainly because Elon Musk has become a lightning rod for those who don't like what the White House is doing. And by implication, they're blaming it on Tesla. For instance, this is from former Vice President candidate Tim Walz saying if he needs a little boost during the day, he just looks at Tesla stock. And even a late night talk show host is encouraging its audience to vandalize Tesla vehicles. And there's also media, perhaps misinformation, but adding to this concern, there's a survey that a German newspaper put out pointing out that 94% said they wouldn't buy a Tesla car. It was an online survey. However, by the end of the day, those numbers had flipped actually, and it turns out 70% of Germans would buy a Tesla. To me, this is reminiscent of what happened with MyPillow. If you're not familiar, MyPillow was a very popular pillow, but it turns out the CEO became embroiled in controversy when he claimed the 2020 election was fraudulent. And as a result, he lost many business partnerships. Well, I think that that's the same moment. This is the MyPillow moment happening to Tesla. So the question is, can Tesla get canceled? Here are the 5 things that I believe represent the competitive strength of Tesla. And I'm going to walk you through it. The first is the strong brand and customer loyalty. I mean, it is synonymous with innovation. But this is exactly what is being questioned today. Historically, roughly 38% of Tesla buyers were Democratic. By 2024, though, that had really changed quite a lot because Democrats were fleeing the brand. So I think Tesla was already suffering from a shift away from buyers based on political affiliation. And President Trump, in just last week, actually talked about buying a Tesla and supported the brand. I'm not sure that Tesla is going to be able to necessarily recover those Democratic leaning buyers, but I think it is strange that somehow Tesla has become a political brand. But there's other reasons to consider. Tesla has an enormous lead in full self-driving, robotics, and AI. That is not changing just because some folks are trying to cancel Tesla. They have a high-quality employee base and an innovative culture. Tesla attracts the smartest employees, the smartest candidates, because they are not only drawn to Elon Musk, but also to the success of the company. They have superior battery technology and a supply chain that is unmatched. And finally, they are a really enormous lead in scale manufacturing. They're one of the few companies that makes money selling electric vehicles, and they have an extensive supercharging network. So if you ask me, is Tesla threatened by the PR nightmare that's happening currently? I don't think so. I think it is ultimately going to be short-term noise. And if you look at the stock price, Tesla has seen this before. The stock has gone through periods of consolidation and then made explosive moves. So it's possible Tesla right now is consolidating, but does that mean it's not going to do what it's done in the past, which is make an explosive move? I don't think so. So to us, we still view Tesla as a granny shot. Now let's review some performance for Granny over the past week. The Granny Shots ETF fell 1.29% over the past week. That's compared to a 2.23% decline for the S&P, so it outperformed by roughly 94 basis points. And if we look at 1 week performance, okay, the top 5 performers over the past week were GE Vernova, NVIDIA, CrowdStrike, Quanta, and Axon Enterprises. And the bottom 5 performers are the ones that were contributing most to the decline are Costco, Intuitive Surgical, Accenture, Abbott Labs, and Apple. From a style perspective, cybersecurity was the leading component of the granny-shot performance, and that is these 5 stocks. The second largest contributor is the style tilt, which has these names here. And just some events to watch over the coming week. There isn't much in the way of earnings, but as we mentioned, and we talked about this, it's the FOMC rate decision that really was, I think, the most important thing. And if you're wondering what a granny shot is, we're referring to an unconventional way of throwing a free throw. The one that has popularized it the most is Rick Barry, NBA Hall of Famer, who made 90% of his free throw shots, and that is superior to a traditional way of throwing a free throw. The way we do a granny shot is focus on longer-term themes like millennials, global labor suppliers, and the rise of AI and automation, energy and cybersecurity, as well as the easing financial conditions. But we have shorter-term themes that we focus on as well: style tilt, seasonality, and the PMI recovery. And in order for a stock to be part of the granny shot, not only does it have to be in one of these themes, it has to appear more than once in a theme. And so the stocks appearing the most often are what we call the granniest of the granny shots. More detail is available on our fact sheet at grannyshots.com. And this is the team behind Granny Shots. Thanks for listening, and I'll speak to you soon. Don't believe, 불어나라 내